All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Happy Fed Day. Today is June 18th, 2025. And the top story this morning is the market is anxiously awaiting the Fed's complete inaction. That's pretty much what's going on this morning. Fed is largely expected to do nothing today, and yet everybody's talking about the Fed. Why? Because, as always, it's all about what comes next. Markets are always forward-looking. We want to know, what is the Fed going to do tomorrow, not so much what they're going to do today. So it's all about the dot plot, or the SEP, the Summary of Economic Projections, where the Fed gets together and they try to estimate what they're going to do for the next few months, few years, and where interest rates are going to be. They do this once a month. And right now, the market wants 2 rate cuts through the remainder of this year. Will the SEP give them those 2 rate cuts, or at least will the SEP tell them they're going to get the 2 rate cuts, or won't they? That would determine the movement in markets today. Now, it's also worth pointing out just how freaking useless the Summary of Economic Projections has been in the past. 5 pennies in the SEP will get you a nickel, because remember, the SEP said, in 2022, they were saying, don't worry, we're not even thinking about raising rates. And then they went on the most astronomical rate hiking schedule that we've seen in years. It sent market into a tailspin lower, caused eventual bank failures in Silicon Valley Bank and Signature Bank. And so you got to take these projections with a grain of salt, but that's what's going to move markets today. Now, to be honest with you, while all this is going on, there are these other things happening, these 2 other stories that came out yesterday that suggest bank regulators and the Treasury and Congress are not sitting around waiting for the Fed to improve conditions in the bond market. They're actually doing these backdoor liquidity maneuvers at the same time. The first is the easing of the supplementary leverage ratio. Oh, now we're getting into bank acronyms, the SLR. Bank regulators announced yesterday, the Fed made the announcement that there will be a meeting later this month to talk about the easing of the supplementary leverage ratio. That is a rule that requires banks to keep extra cash in reserve parked at the Fed instead of taking that money and doing things like buying U.S. Treasuries with it. Because U.S. Treasuries, although they're considered safe assets, there is a risk associated with those assets. See also Silicon Valley Bank, which failed because of losses in U.S. Treasuries. And so we have this rule, the enhanced supplementary leverage ratio, that says banks need to keep a little bit of capital in reserve just in case they lose a lot of money in their loans or in their U.S. Treasuries. We're talking about relaxing those rules. Well, relaxing those rules will allow the banks to take some of that money that's sitting there doing nothing at the Fed and pump it into the bond market, which will add liquidity to the bond market. So even though the Fed may not be easing, even though the Fed may not be cutting, there is this SLR thing going on that will essentially have the same end result, more money being pumped into the bond market. Or the banks might just use it to buy back their own stock. They could also do that, or pay themselves big dividends. Either way, it frees up capital at the banks. Now, the other thing that is going on behind the scenes, or it's not really behind the scenes, it's out in the open, but what's not really being talked about as much is this Genius Act, the Stablecoin Legislation. First of all the things Congress didn't do this year, stablecoins, that's getting done, WTF. But I digress. Yesterday, the Senate passed the Genius Act, which is basically the stablecoin legislation. There is a companion bill making its way through the House of Representatives. That's called the Stable Act. Oh, you see what they did there? Stable, genius, the vanity on display here. But at the end of the day, the stablecoin legislation will also be additive to Treasury market liquidity. It creates rules for regulating stablecoins like Tether, like USDC's or Circle's USDC coin. It basically says, hey, you're allowed to put these things into U.S. Treasuries, and that's it. You have to use a regulated bank to do it. You have to keep those funds separated from your own money and your operating accounts. If this passes and if stablecoins become widely adopted, that means while money is parked in stablecoins as it's chasing crypto around in the markets, that money will, by default, be parked in U.S. Treasuries, which means it will make more money available for the government to borrow. Isn't it funny how that works? So That is also working its way through. Again, it passed the Senate. It's not a law yet. The House still has to get their bill done. And there's two big differences over, is Treasury going to regulate it, or is it going to be the FDIC and the control of the currency that regulates it? That all needs to be worked out. But there's one thing to worry about in this Genius Act and this stablecoin legislation. It may actually be a Trojan horse for central bank digital currencies. I'll show you what I'm talking about in there. Be careful, guys. Congress getting all excited and, oh, yay, we're going to adopt crypto. It's kind of the whole reason that we started this thing, Bitcoin, right? The whole reason Bitcoin came into existence in the first place was because Congress was such a CF of financial irresponsibility. So when I see Congress getting their filthy fingers into crypto, it kind of makes me not want to be there. As always, guys, crypto winter remains right around the corner. Be careful going out on leverage. Now, meanwhile, the Fed is going to be talking all about this morning or this afternoon in their press conference about how they feel monetary policy is sufficiently restrictive and that it may be appropriate at a later date based on the totality of incoming economic data to reduce the level of restrictive monetary policy. If monetary policy is really restrictive, why is Goldman Sachs getting back into the SPAC business? Can somebody explain that to me? As I say often, are these tight financial conditions in the room with us now? SPACs, that's special purpose acquisition companies. In other words, blank check companies. It's a stock representing a pile of money that's going to go out and buy some company. Nobody knows what company they're going to buy. Just buy the stock now, ask questions later. This was all the rage in 2021. And of course, people who went chasing SPACs lost pretty much everything while Chamath made billions and started his stupid podcast. But after all is said and done, most people that went chasing SPACs got wiped out. All those EV and battery startups, they're filing for bankruptcy, another one every day. Well, now Goldman is getting back into the SPAC business. So if financial conditions are tight, why are blank check companies making a comeback? And there's one chart that explains why they're making a comeback. Here's a hint. Financial conditions aren't really tight. They're actually incredibly loose. Leverage is building up in the system, and this is just further proof that there is too much freaking money in existence. Meanwhile, we had another story yesterday, a very big story that did not get very much coverage. There was talk about it on FinTwit, but when you really think about it, wow, this story, and I kind of understand why the press is not drawing too much attention to it. SEPA Bank in Iran. Apparently, this is the third biggest bank or one of the top three banks in Iran, and it's the bank where the Iranian Revolutionary Guard Corps keeps all their money. It's basically the bank account where all the soldiers get paid in Iran. That bank was hacked yesterday by an Israeli hacking group, and according to the claims, which have not been confirmed, the hackers claim that they deleted everything in their database. Basically, they deleted the bank account. If you had money at SEPA Bank, it's gone if this story is really true. And it's hard to verify something like this because there's no transparency into what goes on in the Iranian financial system because of all the sanctions. It's all siloed. That being said, there was a lot of reports on X yesterday of people saying that their ATMs weren't working. They couldn't access their accounts. They couldn't get their cash out. Yikes. If that is really true, number one, it's hard to fight a war when the soldiers aren't getting paid. And number two, if they can do it, or if we can do it, somebody else can do it. As with the drone attacks in Ukraine and the drone attacks in Iran, I hope somebody's paying attention because the other side could do it to us someday. And if it's really true that hackers can just go into a bank and delete everything and basically your money ceases to exist when that happens, if you're in that bank and there's no backup or it can't somehow be recovered, then none of us owns nearly enough gold, if that is actually possible. Oh, and apparently last night they also hit a crypto exchange as well. Just a reminder, guys, don't leave your crypto on the exchanges. It is not safe there. We've also got layoffs at Intel, and we've got one more Iran story this morning. A former Iranian finance minister is saying that ships should be asking for permission from the Iranian government before transiting the Strait of Hormuz. A lot of people are pointing out that this is a former minister. That's an important qualifier there. So it's unclear if this is Iranian government policy or just a guy saying a thing. But as always, there's a lot of attention being paid to the Strait of Hormuz. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's happening in the world of finance today. And as always, please hit that like button and that subscribe button if you're new here so you can come back tomorrow and have your coffee with the Melonheads, because we do this one every day. Right now, markets are going a whole bunch of nowhere. They're just sitting around waiting for the Fed to tell us what they're going to do or what they plan to do. The S&P is higher by 7 points, or 0.13% higher this morning. The Dow is up by 24 points, or 0.06% higher. And the NASDAQ is higher by 53 points, or about 0.25%. So stocks pretty much flat with a slight bias to the upside this morning. Meanwhile, we've got a slightly weaker dollar, 98.64 on the DXY. That is down by about 19 basis points this morning. And the bond market is quiet once again. Again, expect some movement later today, depending on what the Fed does. But for now, not a whole lot going on here. The 30-year Treasury, 4.870. That is down by 2 basis points and change. The 10 years at 4.370. That is also down by 2 points. The 2 years at 3.941, off by a fraction of 1 point. And the 1 month is at 4.192. That's actually up by about half a point. Meanwhile, looking over at the commodities board, we've got a whole bunch of nothing going on in commodities this morning. Gold is flat here, $3,390. That's higher by about $2. Interesting thing yesterday with gold. Everybody was talking about all these statements that President Trump was making, unconditional surrender. Everybody was saying bombing was imminent and the U.S. was about to enter the war. And we have this big announcement later today, all this stuff that was going on, all this bluster and all this saber rattle. And the price of gold did not care. I thought it was kind of interesting. I put it out on Twitter basically saying, look, gold is saying they are not convinced the United States is about to enter the war. And, well, nothing happened last night. So it's important, guys. If you're hearing all this bluster and all this stuff about what's going on in the Middle East, check the price of gold, check the price of oil. If those two things are not moving, then it's just saber rattling. Meanwhile, the silver is down a little bit this morning, $37.09 for my favorite of the shiny. That may be off by a couple of pennies, but we hit a high this morning of $31.32. For spot silver. We've got the front month silver contract for July. That one went as high as $37.40 this morning. So silver continues to rip here. It's flat at the moment, but had a really good day yesterday. Again, guys, I think we're probably headed into the 40s here, barring some kind of catastrophe. Meanwhile, copper is higher by about 0.8%. We've got platinum is higher, back above 1,300 for July platinum futures this morning. That's higher by 3.25%. Palladium is up by 0.6%, and WTI crude is up by another 0.5% this morning, $73.65 for the August WTI futures. Looking over at Bitcoin, it is down by about $560 here, $104,034. If we were expecting a big surge in Bitcoin because of the Genius Act passing the Senate, then you got a lot of disappointed people here. So far, no big reaction in the crypto space. But this is the big one this morning. The Fed is likely to keep rates the same, but give a forecast that moves markets. Here's what to expect. Federal Reserve officials get to voice their outlook this week on the future path of interest rates, along with the impact that tariffs and Middle East turmoil will have on the economy. While any immediate movement on interest rates seems improbable, the policy meeting, which concludes today, will feature important signals that could still move markets. Among the biggest things to watch will be whether Federal Open Market Committee members stick with their previous forecasts of 2 rate cuts this year, how they see inflation trending, and any reaction from Chair Powell to what has become a concerted White House campaign for easier monetary policy. You will see journalists fishing for talking points and statements that they could use against President Trump, as always. The Fed's main message at the June meeting will be that it remains comfortably in wait-and-see mode. Bank of America economist Aditya Bhav said in a note. B of A said it expects the Fed won't cut at all this year, but will leave open the possibility for one reduction. Investors should focus on Powell's take on the softening labor data, the recent benign inflation prints, and the risks of persistent tariff-driven inflation. Now, it's interesting to see B of A calling out softening labor data here, because not a lot of talk about that softening labor data. We got some more labor data this morning that was pretty soft. We'll get to that later in the show. But most of the narrative in the press has been that the labor data was resilient and strong, because that headline jobs number, which I said many times, was really not as good as it looked. The committee's dot plot grid of individual members' rate expectations will be front and center for investors. At the last update in March, the committee indicated the equivalent of 2 quarter percentage point reductions this year, which is in line with current market pricing. However, that was a close call, and just 2 participants changing their approach would swing the median forecast down to 1 cut. Of course, a swing down to 1 cut this year would probably send markets lower if that were to happen. So again, no big movement on rates expected today. It's about what are the forecasts going to do. Meanwhile, as this is going on, we have these other bond market liquidity pumps happening. The first, U.S. plans to ease capital rule limiting banks' treasury trades. The supplementary leverage ratio is back in everyone's vocabulary. The top U.S. bank regulators plan to reduce a key capital buffer by up to 1.5 percentage points for the biggest lenders after concerns that it constrained their trading in the $29 trillion treasuries market. The Federal Reserve, the FDIC, and the Office of Comptroller of the Currency are focusing on what's known as the enhanced supplementary leverage ratio, according to people briefed on the discussions. This rule applies to the largest U.S. banks, including J.P. Morgan Chase, Goldman Sachs, and Morgan Stanley. The proposal would lower a bank holding company's capital requirement under the ESLR to a range of 3.5% to 4.5%, down from the current 5%, according to people who didn't want to be identified discussing non-public information. The firm's banking subsidiaries would also likely see their requirement reduced to the same range, down from the current 6%. The proposal will look to change the overall ratio rather than exclude specific assets like treasuries, as some observers had predicted. Still, it expected to ask for public comment on whether the agencies should carve out treasuries from the calculation, the people said. The Fed said on Tuesday that it plans to meet on June 25th to discuss the plan. The other regulators hadn't yet announced their agendas on the enhanced version of the SLR. So look, what it really comes down to is a reduction of the supplementary leverage ratio frees up money for the banks to go do something with. They could either go make more loans, they could either buy more treasuries, or they could just pay it out to themselves in the form of dividends or stock buybacks. The Fed is getting together this week to talk about it, and that probably means some kind of change would happen in July and August if they decide to move forward with that. Meanwhile, we've got stablecoin legislation. This one this morning or late yesterday in Crypto Slate. Treasury Secretary Bessent says stablecoins are debt relief engine as Senate readies to vote on the Genius Act. If the Fed won't lower rates, they'll use crypto to get those interest rates down one way or another. And they're using stablecoins to do that. Treasury Secretary Scott Bessent stated on June 17th that stablecoins could cut federal borrowing costs and slow debt growth if Congress sends the Guiding and Establishing National Innovation for U.S. Stablecoins Act to the president. That just means they really wanted that acronym to say genius. In an X post, he pointed to research projecting a $3.7 trillion stablecoin market by 2030 and argued that the bill would accelerate that expansion by setting reserve, audit, and licensing rules. Bessent called the outcome a win-win-win for issuers, the Treasury, and consumers because payment coin reserves would sit largely in short-dated U.S. Treasuries, lifting demand for the securities and easing financial pressure. The bill would require every payment stablecoin to hold high-quality, highly liquid assets equal to tokens in circulation, chiefly Treasury bills, or insured deposits while barring issuers from offering yield. Accounts segregated from operating capital must hold the reserves, and issuers must implement Bank Secrecy Act programs, conduct customer due diligence checks, and report suspicious activity. Entities with more than $10 billion in liabilities would need a federal charter, but smaller issuers could operate under state regimes that meet federal standards, subject to joint examinations. The legislation directs the Treasury to publish quarterly reserve audit templates and grants the Commodity Futures Trading Commission limited enforcement authority in the spot market. Now, here's the interesting thing. I get the idea of stablecoins adding liquidity to the bond market. I understand that. That checks out. That being said, there's something that really smells bad about this. And you get it on this website here. This is the Senate Banking Committee website, and they're doing this myth versus fact about the Genius Act. You know, this is a website promoting the legislation. But this first myth that they're supposedly busting here on this website kind of worries me. Myth number one, the bill does nothing to prevent stablecoins from being exploited by terrorists, cartels, and criminals. But the fact, they're saying, is the Genius Act requires all stablecoin issuers, including foreign issuers, to have the technological capability to freeze and seize stablecoins and also comply with lawful orders. And that's what worries me, because that sounds an awful lot like a central bank digital currency to me. Maybe it doesn't exactly meet the CBDC definition, but if the government is going to reach into stablecoins and say, I don't like this person for whatever reason, I want you to freeze his assets, I want you to take his money away. Well, isn't the whole point of crypto and Bitcoin to put some distance between yourself and that? Isn't the whole point to be outside the reach of governments, which have absolutely destroyed fiat currency? And look, let's be honest. Yeah, I'm all for fighting terrorists and cartels and criminals. But at the same time, governments like to play fast and loose with the definitions of those things in order to freeze the assets or steal the money from people who do things like, I don't know, refuse to get certain shots or go to certain protests or, I don't know, don't embrace whatever diversity initiative is currently in vogue. Any number of reasons that the government might label you a terrorist and use to just take your money. It seems like that is built into this stablecoin legislation. And, well, I just don't like that. I'm all for fighting criminals. But again, when you give too much power to the government, they just change the definition of criminal to be anybody they don't like. Meanwhile, Goldman ditches the ban on Spax as blank check firms stage a comeback. Look, I don't want to spend too much time on Spax and everything. All I can tell you is most of the people who waded into the Spax space in 2021 and 2020, most of them got wiped out. Those companies, a huge swath of them went bankrupt. Their stocks are trading for pennies on the dollar if they did survive this long. Meanwhile, people like Chamath, can't pronounce his name, made themselves billions of money pumping this stuff. The people who sponsored this and the people who pumped this crap in the media, they did really well. Everybody who invested in this garbage lost money. And Goldman is getting rid of their ban on Spax. So blank check companies are making a comeback here. If financial conditions are really so tight, if we're really in restrictive monetary policy, why is this happening? I'll tell you why this is happening, because there's too much freaking money circulating around, because financial conditions aren't really that tight. And this chart proves it. This is the M2 money supply. And look, guys, does this look like restrictive monetary policy? Here we are in 2022, back when the SPAC craze was coming to an end, right? When SPACs had become so popular, people were just throwing tens of billions of dollars at companies that they had no idea what their business would even look like. Just buy a stock, any stock, phase 3 profit. And then the Fed started their quantitative tightening regime and interest rates. And we did see some credit contraction, and we saw the money supply shrink right up until the banks started failing in March of 2023. And then, that slowed down, and then it reversed in October. And then all of a sudden, we've had trillions of dollars in monetary expansion. Now, I'm pretty sure private credit is behind this growth in the money supply. Whatever the cause is, there has been a huge growth in money supply, and now stupid crap like the SPAC craze is coming back. These two things are related. And the Fed is sitting here talking about cutting. We're talking about lowering interest rates. We don't need to lower interest rates. If this kind of garbage is building up in the system, it means monetary policy is not restrictive enough, not too restrictive. But you know what? Number must go up at all costs. So forget all logic and caution. Just pump that number higher, right? Meanwhile, we had big news overseas. Look, I get it. There's a lot of Iran-Israel fatigue going on, but this story did not get nearly enough attention yesterday. Suspected Israeli hackers claim to destroy data at Iran's bank SEPA. And that is a huge story, because destroy data, that means they pretty much deleted the money. That is huge if they really did that. An anti-Iranian government hacking group with potential ties to Israel and a track record of destructive cyber attacks in Iran claimed in social media posts on Tuesday that it had destroyed data at Iran's state-owned bank SEPA. The group, known as Predatory Sparrow, hacked the bank because they accused it of helping fund Iran's military, according to one of the messages posted online. And I can tell you there were all kinds of messages posted on X yesterday of people showing ATMs that were not working, people complaining they couldn't reach their money. And again, guys, if they can do it, somebody else can do it. And they could possibly do it to us. If this becomes a thing, if hacking into banks and deleting the data, not just ransomware, not just siphoning some crypto or something, like actually deleting wholesale bank data, that is immensely destructive. And if that's really going to become a thing now, then none of us own enough gold. So have some money outside the financial system. As always, I like the shiny. And by the way, it wasn't just the bank. This same group now says that they hacked the crypto exchange Novitex and that they stole $90 million. Again, same group, this whatever Sparrow that they're claiming they call themselves. They also stole about 90 million in crypto from the Iranians yesterday. So just a reminder, guys, don't leave your coins on the exchanges. They're not safe there. If you don't hold it, you don't own it. Meanwhile, Intel is laying off workers again. This one broke a couple of days ago now, but it is still circulating. Intel to lay off fab workers in mid-July. The company aims to refocus on more engineering talent. We've heard a lot about Intel layoffs. This time they're focusing on their foundry workers. And the reason this is important, we don't know how many. They're saying it'll be about 20% of their foundry workers, so it's probably going to be a few thousand layoffs. But the big thing here is, didn't we just get done pumping tens of billions of dollars into the chips industry? You remember the CHIPS Act? Wasn't that supposed to get these companies to build foundries here in the United States? Well, all I see them doing is making all kinds of promises, trying to get loans from the government, trying to free up all this subsidy cash, and then laying off the people that would work at the facilities they claim to be trying to build. Once again, like, what the hell was the point of the whole CHIPS Act? They haven't done anything with it. Intel cutting even more jobs. Also, back on the Iranian story for a second here, a former Iranian minister calls for Iranian control over the Strait of Hormuz. I don't know if this is official Iranian government policy or just a guy saying a thing, or maybe it's a test balloon trying to gauge the reaction of people. But former Iranian economy minister, something I can't pronounce, has said that tankers and LNG cargoes should only transit the Strait of Hormuz with Iranian permission. And this policy should be carried out from today, i.e., for 100 days. It was not immediately clear whether this guy was echoing a plan under the Iranian establishment's consideration or just sharing his personal opinion, probably something of both. They're just trying to rattle markets and see what happens. But the price of oil is kind of calling BS on this one, guys. Look, oil, when this conflict broke out, we went from the high 60s to the low 70s. But we're still, there's a bias to the upside, but we're still trading within the intraday range of the first day of the shooting on Friday. Oil right now at $73.94. If Iran had really closed the strait and demanded everybody ask permission, oil would be a hell of a lot higher here. So for now, guys, when you hear this bluster in Iran, or you hear the bluster in Israel or in Washington, D.C., look at gold and look at oil. If they're not moving, then it's just more talk. Meanwhile, we got some labor data this morning once again, and it's a little bit better than last week, but still pretty bad. Initial jobless claims for the week ended June 14th decreased. They went down to 245,000. All right, so they're a little bit lower. That's optimistic. But if you look, they came down from a pretty big high of 250,000. And you can see several weeks in a row now, we've got a new higher level that initial jobless claims have settled at. Now, again, this level's still relatively low, historically speaking. People are not being laid off en masse just yet. But as always, the continuing claims continues to be a problem because those who have lost their jobs can't find a new one. Continuing jobless claims in the United States decreased. Again, they went down to 1,945,000 for the week ending June 7th. That's down ever so slightly from 1,951,000 the previous week. All right, they're down by about 6,000, but again, look at this chart. It's hardly a decline here because we're down from a cycle high level. People are still having a hard time finding jobs once they lose them. So maybe this is some of that weak labor data that the Bank of America analyst was talking about. Again, when Jerome Powell gets together today, when he talks about these tight monetary conditions, when he talks about the resilience in the labor market, number one, monetary conditions are not tight. See also money supply growth. And number two, the labor market is not robust. See also that horrible jobs report that saw hundreds of thousands of full-time jobs lost, big downward revisions to prior months, and these elevated continuing unemployment claims. So the two big reasons that the Fed is sitting there saying, yeah, we're going to sit tight and do nothing, they're the wrong reasons. The labor market is not strong and monetary conditions aren't tight. But all that being said, Goldman is pumping Spax again. That means there's too much freaking money sloshing around in the system. So the Fed is right to do nothing. They're just doing nothing for the wrong reason. And last but not least, it's not all bad news. The United States will drop their guidance to limit alcohol to 1 or 2 drinks per day. So we got that going for us. The government is telling us, drink up, everybody. We're ditching our guidance that says don't drink any alcohol. Now, look, I've seen a lot of articles in the last few weeks and months talking about how global alcohol consumption was on the way down. And yeah, guys, I get it. Surgeon General's warning, all that stuff. But booze is bad for you. I get it. Drink responsibly, all that stuff. That being said, this might be the best news for the plummeting birth rate that we've seen in a long time because, hey, if people are going to be drinking more, then maybe we're going to be making more babies. I've said it several times, guys. We all need to drink up and make bad decisions because we're just not having enough kids. And a society without kids is a society without a future. Kids have a stabilizing influence on people. They force them to get their act together. And, well, most people are not having kids for good reason because they can't afford it. But I can tell you our economic problems will not get better if we don't start having babies. And this is not just a U.S. problem. This is a huge problem in Asia. It's a huge problem in Europe. Basically, Africa and South America and India are the only places in the world where the population isn't in free fall right now. All these projections about how we all have to eat bugs because there's going to be 50 trillion of us in 10 or 50 years. They're all BS, guys. The world's population is about to start declining, and we're already seeing it in many different places. One more quick one here. Shout out to Nightingale Associates on X who posted this one. Remember that whole commercial real estate thing? That is still out there, guys. Extend and pretend. We started doing that in 2022. Let's check back with some of those extended and pretended deals and see how they're working out. June 2022, the Walden Galleria owner avoids loan default with a 3-year extension. All right, there was the extend and pretend 3 years ago. So it's now been 3 years. What happens? May of 2025, Wells Fargo initiates foreclosure on the Walden Galleria, Western New York's largest mall, after default on a $220 million loan. It was appraised at $600 million in 2012. So we extended and pretended for 3 years. 3 years later, it ends up in foreclosure anyway. Just a reminder, guys, they didn't fix the problems in commercial real estate. They just swept it under the rug or pushed it out in front of us or just ignored it. It's still out there. There is a lot of unrealized losses in the commercial real estate space. So I don't know, maybe ask for another 3-year extension and hope for the best. Good luck with that avoidance of price discovery. And I just want to say thank you very much to my man, Mish, who says public reminder that tomorrow is a federal holiday. That is correct, guys. Tomorrow is Juneteenth. Markets are closed. So sadly, there will be no live show tomorrow morning. You'll just have to get your morning market fix elsewhere. But we will be back on Friday as usual. Thank you, Mish, for supporting the channel, sir. And thank you for being a Melonhead for 16 months. And welcome KDM to the Melonheads. Thank you, sir, for supporting the channel. Just a reminder, guys, if you are a Melonhead member, you get a free super chat once a month. Feel free to use that, and I will read and respond to your questions live on the air. And there are 20 more of you coming. Thank you, M&J, for gifting 20 memberships. That's a lot of new memberships. Welcome, you 20 new Melonheads, and be sure and say thank you to M&J. Thank you so much, M&J, for supporting the channel and for keeping things neat and tidy in the chat as a moderator. I appreciate that very much. Steve Woitis says, is there still lots of liquidity? Where is it coming from? Banks, Fed, Treasury? It is coming from the banks, and it is coming via a middleman. My best guess at where all this new money is coming from, I've looked at, where it's not mortgages. They're not making that many loans. A little bit of new money coming from buy now, pay later. That's new debt that's being loaned, money being loaned into existence, but that's in the tens of billions. That M2 money supply chart, that's gone up by like $1.5 trillion. There's been some credit card expansion, but again, that's in the billions. The only thing big enough is the private credit industry. So I think all of this money that is out there chasing assets, avoiding price discovery, bidding up things that should have declined sharply a long time ago, I think it's coming from private credit. And I talked a lot about this with my buddy Travis over at Real Estate Mindset in a video that was published a few days ago. The banks are not allowed to make these loans. And so we've got non-banks, which are taking out big loans from the banks and then taking that money they borrowed from the banks and lending it to the people the banks aren't allowed to lend to. I think that's where all this extra liquidity is coming from, to be honest with you. And I used the metaphor in that video. You've got people are dancing on a tree limb. That's the banks and the non-banks. They're moving further out on the limb. And while that's happening, Jerome Powell is cutting into the branch by quantitative tightening and reducing bank reserves, leverage building up in the systems, and it's not hard to envision what happens if that continues. So, yeah, that's risky. But, number go up. Let's not interfere with number go up. Thank you so much, Steve Voitis, for supporting the channel, sir. I appreciate that very much. Pigo's Trading Desk says, don't forget about DigiCash. Magic Money Fin 2001. I don't remember DigiCash, Pigo. I'm not sure what it was, but I don't hear about it anymore. So I'm sure DigiCash probably, went the way of all the other things that disappeared circa 2001. Yeah, that's interesting. 2001, DigiCash. Was that like a first attempt at crypto? I'm going to have to parking lot that one, Pigo. I've never heard about it, but thank you for the tip and for the information. And PP Poo Poo, hello 4P. He says, hey, Jack, thanks for being awesome. You're welcome. Love the work you do. I even asked Janet. She seconds my opinion. Wow, you asked Janet what I think, and Janet says, where is she here? She says, oh, yes, I really love Nobody Special's morning show. I find Jack's live streams are strong and resilient, much like our banking system. And I, again, would just love to wish my successor, Scott Bessent, good luck with his liquidity pumping operations, because I relied so heavily on short-dated treasury bills when I should have been terming out United States debt. And now Scott Bessent has to pump stablecoin legislation and suspend the supplementary leverage ratio to undo all the mistakes I made. But if you'll excuse me, I have to go out and collect some speaking fees from all the banks that I served. I mean, from my time at the Treasury and the Federal Reserve. Well, thank you once again for the candid discussion, Secretary Janet. I really appreciate the honesty that you show here on this channel, which diverges significantly from the levels of honesty on display elsewhere in your public speaking. You only get the real Janet here, guys. What can I say? Thank you, 4P, for supporting the channel. Welco Services says he will read anything if you put it on the teleprompter. I'm Ron Burgundy. Thank you very much, Welco Services, for supporting the channel. Dance Monkey Dance. Nashville Pasta Man says, Gloria will supervise the stable coins. Perfect. Who's Gloria? I'm not sure who Gloria is in this case, but yeah, supervising stable coins. The Senate bill says it's going to be the Treasury that gets supervision, also the CFTC. The House bill says it's going to be the Federal Reserve, the FDIC, and the controller of the currency. So everybody wants a piece of regulating stable coins. I don't know what the finished product is going to look like, but at the end of the day, it's about making money easier to borrow from the government. That's ultimately why they're doing it. That's why Congress is pushing this while ignoring all their other responsibilities. I mean, hey, why cut spending when you can pump backdoor CBDC legislation that makes it easier for you to run up the debt even higher? Then you can claim to be a fiscal hawk when campaign season comes around and then go back to doing nothing about our spending problem. Thank you very much, Pasta Man, for supporting the channel. Hunt and Cover, thank you, sir. He says, affordable care for Mini-Me. Have a good one, Jack. Coffee for you and Gigi later. Thank you so much, Hunt and Cover. I appreciate the generosity and the support of the channel, as well as the good vibes for my Mini-Me. She is doing much better, by the way. She's just bored to tears. The kid's a tomboy, and just got to keep her from hurting herself again. She's bored to death. We're doing what we can. Thanks again, Hunt and Cover. And Robert Feeds the Machine says, Jack says alcohol is the way forward. All I can tell you is I'm doing my part, Robert. Look, the declining birth rate, the declining consumption of alcohol, I do think they're related. But at the end of the day, it's a silly joke. But we really do need to start having babies. All that part about how if you don't have kids, you don't have a future. I am not kidding about that. All these people who are like, I mean, we spent a whole generation convincing young girls that having children is somehow serving the interests of the patriarchy. And okay, great. You went chasing boardroom success and, oh, okay, awesome. Now you're on your deathbed 40 years later. You have no legacy. All the people you used to work with don't even care that you're dying. Are you looking back on your life and you're happy that you attended that extra board meeting? Or are you looking back on life kind of wishing you had something to leave behind? Hey, I just call it like I see it. Honestly, I think we just need to start having kids again. And, I didn't get my act together. Like financially, I was a knucklehead, and I just blew money on whatever I wanted. I mean, I've always been cheap, but I didn't really get my act together until I had my kids, because I was forced to get my act together when I had kids. I had no choice. It wasn't just about me anymore. And I think the stabilizing influence on that is largely being ignored. And I think you can kind of see that, like, if you want to extend that a little bit, or maybe take a little bit of liberty with it, look at what happened in Jamestown. The only reason the first colony in the New World even succeeded was because women showed up. When it was all just guys living in this dangerous frontier, they were just out doing stupid crap, trying to dig up gold. Nobody was growing any food, and everybody died. As soon as women showed up, all of a sudden we had a future again, because, oh, well, maybe I get a girl, maybe I have some kids. That colony succeeded. All right. And so if you take away prospects of reproduction, if you take away the future, what are you left with? A bunch of degenerates who just do whatever they want whenever they feel like it, because they want to, without any care for the consequences. And I really think this declining birth rate is a bigger problem than a lot of people realize. It's certainly a huge problem in Asia, and it's a big problem here too. Thank you very much, Robert Feeds the Machine, for supporting the channel. We kind of went on a tangent there, but thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Just a reminder, no show tomorrow because markets are closed, so we'll be back on Friday. Thank you so much for the super chats and the generosity. Also, thank you to my magnanimous Melonheads on Patreon and YouTube for everything you guys do. Links down below should you feel so inclined. Don't forget that like button on the way out and that subscribe button if you're new here. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.